Namaste and welcome to the Federal on arguably a day of absolute bloodbath on our stock markets in India and also globally. We are here having a discussion at the Federal. We'll be joined by a couple of investment experts, a fund manager and an investor. And we will be discussing about what exactly has happened, how does things look going forward, and things like that. So we will be joined by a couple of investment experts. We'll be joined by Senthil, a fund manager with Crest Wealth Fund Management here at Chennai, and also Anand, who's a proprietary investor and a stock market veteran. Right. So what exactly happened? The Indian benchmark Sensex today witnessed its biggest ever fall in. I mean, I not know in absolute terms. Of course, the crash came. I had fears of a global market slowdown due to the COVID-19 outbreak. So to discuss, we also saw things like the rupee. This unprecedented crash has had an effect on the rupee markets as well as yields on the bond markets, and we'll be discussing this going forward. Can we now? Senthil should be joining us on this call. Senthil, are you? Hello, Senthil. Thank you and welcome. So, how's the day been? First of all, thank you very much. Today must have been a very tight day for you. Appreciate the fact that you managed to join us immediately after the market closed. So, briefly, how was the day and what's your reaction so far on this?
Hi Venkat, thank you. So today, as yes, you would have seen the market. It's down by close to 800 points on Nifty, Sensex, and Nifty. It's close to 8% in terms of percentage points. So it has been expected because global markets are also on the turmoil. Since this coronavirus breakout, all the world markets have fallen close to some 15 to 20%. Whereas one irony is China. China is plus 0.3% vis-a-vis other countries since the coronavirus breakout. We are also in that same range. We are also considering today's fall. We will be in the same range, around some minus 19%. So we are going with the same wavelength and the same magnitude along with the world markets. So going by the past history, yes, even during the SARS situation, the same thing has happened. Around some 15 to 20% fall, and then market recovered from there. Hope everything will settle down, and then we will see a bounce back soon.
Okay. And but are you optimistic? Do you think these are opportunities for people to be? I mean, can you catch falling knives? I remember that used to be what used to be discussed way back in market days. Does it make sense to go and catch falling knives? Is that okay? Are these bottoms? Are there opportunities here? How would you look at this as far as opportunities are concerned?
Okay, so let us look at what are the reasons behind the fall. So on a broad basis, one is this coronavirus, one, and then the second one is yes bank crisis, which is a domestic crisis, and number three, oil breakout, oil plummeting to $30. So if you look by reason, one is coronavirus. If we compare with the past historic virus issues, something like say the latest which we can take is SARS. Even for your information, like SARS doesn't have any medication, so it got settled on its own because of humidity and temperature. The virus will not be able to spread out throughout the system, so it'll stop. Spreading it out, and then it will get eliminated from the system. So hopefully, even if there is no medicine for the, even if they are not able to find any medicine for COVID, I think it will get settled down slowly as and when the temperature and humidity rises across the world. So maybe another say 45 days to 2 months. I think it will get settled down. Already, you can see the number of cases coming down in China and South Korea. So already, both the countries have peaked out and then started settling down. One. And the same precautionary measures has been taken by other countries. Then it will get settled down, and once it gets settled down, the scenario will be totally different. Number two, Yes Bank. So Yes Bank fallout. Actually, I mean, the government, I mean, SBI has stepped in the right time, and then without affecting the investment for the shareholders of the SBI, they have considered that as an investment opportunity, and then they are pumping in the money without affecting the public deposits.
Yeah,
So,
we
eh,
cover the Yes Bank case. I'm sure I'm going to be asking you on that. On the warm break
yeah,
also of the COVID, we have been discussing this on federal. We have been interacting with public health people. Yes, there's been cases, but there are no confirmations as yet, and we are hopeful that summer should kill the virus. But there have been cases like, for example, measles is there during summer, and even the Saudi Arabia MERS was during summer. So
yeah,
we will come to that aspect later. Now, can we have Anand? Anand, what was is Anand? Yeah.
Yes, I
Anand, welcome to the federal. What is your initial reaction for the crash of 2020? If that's what
I
is.
have a completely different take from my good friend Senthil. See, markets have been overvalued. I am reminded of Lord Keynes, who said markets can remain irrational longer than you and I solvent.
Hmm.
See, for the last 6 years, Indian corporate earnings have gone nowhere. The Nifty EPS is 450 rupees today, I'm told, and it was around 400 when this government came to power. In last 6 years, corporate earnings have been very anemic. So if you go by the long-term average of the Nifty, you can charge between 15 to 18 times earnings. So basically, you are looking at a level between 6,000 and 7,500 on the Nifty. And this, if your earnings are going to grow and you are very optimistic. But like Manmohan Singh wrote in Hindu recently, there's a trinity of actions in India which does not give us the confidence that corporate earnings are going to grow in the near future. Also, unlike my good friend Senthil, I disagree. I believe that the regulator, especially the Reserve Bank of India, has been sleeping on the wheel for the last 2 years. The Yes Bank crisis has been known to us from 2018, and there was a governor, there was a person appointed onto the board of Yes Bank by the Reserve Bank. The Reserve Bank should have resolved this issue about a couple of months back instead of waiting for it to be on a default. It almost defaulted on a bond payment before the Reserve Bank stepped in. So I believe it is too little too late. And Corona is only a trigger. And there are many other malaces in the Indian economy which need to be addressed before we think of a recovery in the Indian market.
So are you saying, Anand, that the problem is that actually the fundamentals are uh, not there? Sendil, I mean, is Sendil also in? Yeah. So, is it a problem with the fundamentals? Is that what you are?
I I definitely say it is fundamental. And yesterday I was listening to Dr. Rajan in one of the TV channels, and Dr. Rajan shares the same news. Dr. Rajan is of the opinion that the financial sector in India needs a cleanup, and he started in 2015, and he was not allowed to complete it. So you cannot live forever by evergreening the balance sheets of banks. So, if Yes Bank has failed, then except State Bank of India, none of our public sector banks are solvent. They are only solvent because there is a sovereign guarantee. And the Reserve Bank has complicated issues by writing down the Tier 1 bonds. I am not for one saying that they cannot write the Tier 1 bond. But even before you write the Tier 1 bond, you must have written the equity to zero. This basic knowledge of a waterfall in a case of a bankruptcy seems to have escaped the Reserve Bank's notice. How can equity be alive? And when you have a Tier 1 bond, you can write to zero. And who has taken hit on the Tier 1 bonds? It is the mutual fund. And only retail subscribers like you and me who are subscribed to the mutual funds who are going to take a hit. So there is no application of mind on part of the regulators to solve an issue. I don't understand how can you say that this is only a corona issue that will go away in 3 months.
No, I mean, but I think it's a fair point that Senthil did make in terms of the immediate the trigger for excuse me, the trigger for an immediate action could is definitely
It is definitely, the trigger is definitely Corona. The trigger is definitely Corona because it forced the foreign investors to take money outside India. Money from FPI, foreign investors fled to the US Treasury and gold. And because they fled to Treasury and gold, is why the economy, why the markets have fallen. But fundamentally, last year, even Turkey had a better, if you look at the Indian market, Turkey outperformed Indian markets in terms of dollars. If you look at the dollar Nifty, that is the dollar equivalent of the Nifty, your return from 2008 to 2020 is zero or almost negative. Your stock market has not returned anything for 2008 to 2020. What market are we talking of?
Okay, so we'll go. So Senthil made a very valid point in terms of this is not the first time where an epidemic has created a market crash, and we saw during the time of SARS and MERS where uh, you know the markets did recover. So Anand, do you think it's the same right now, or do you think the things right now are fundamentally different, and hence scope for a recovery is
No, no,
not?
no. I won't compare SARS. In fact, the nearest thing you can compare to this is the 1918 Spanish flu epidemic. In 1918, the Spanish flu epidemic, the market did correct, but you cannot look at a time before World War II with today because we had a gold-backed currency then. Today you have fiat
No,
currency.
I get your point. In terms of a pandemic, you would like to compare it with the flu
Yeah,
pandemic.
so SARS is nothing. SARS is like a mosquito bite in front of this.
Uh, I know we'd look at it now. To you, Senthil, I would definitely. I mean, I have one particular. I can't say grouse, so don't mistake me for this. Uh, when fund managers, I have been, of course, trying to talk, and I did talk to a couple of them, and everybody was saying that it's a healthy fall. Valuations are now become reasonable. The froth has been removed. Uh, Opportunity. Actually, I did speak to a good friend of mine just now, even before, and he said there's actually opportunity to buy now. But my question is, how come we never hear the opposite at market tops, especially from fund managers? We don't hear them saying it's due for a fall, valuations are crazy, take your money and stuff like that. So, this is more because are fund managers eternally optimistic? Is that how we have to take Senthil?
No, two things towards it. One is even, I mean, there are fund managers who have come out and then told that there are certain sectors which are, I mean, overvalued. So don't invest in those sectors. And even there are fund managers today, even, I mean, recent last 1 month or 2 months, the top class fund managers have come out and said, like in certain sectors, there is a frothy valuation. So the same thing has happened in 2007 in infra and then 2002 in IT. So better don't put again and again the same money in the same, I mean, the IT sector or the infrastructure like in 2007 or 2002. The same thing happens in today also in some sectors. So they are very sector specific. Uh, and they are calling out like, okay, don't put money in those sectors. And the second question, I mean, to your second question, why fund managers don't say like come out and then it's all frothy valuation. Always we found out there are some packets which gives a I mean investment opportunity, and fund managers are looking all those opportunity, and the only difference is their time frame is different and the investor time frame is different. They are looking on a 5 to 7 years horizon, and then the investor who is investing wants to reap the fruit the next month or 6 months from now. So the time horizon differs, and always when you go by the time horizon of 5 to 7 years, obviously, I mean everyone has reaped the return. So it's not something like they are not reaping the returns. On the time horizon of 5 to 7 years, always there is a positive return, and even there are case studies like if you put a money continuously on a SIP basis or on the lump sum basis on a 5 year basis, last even in Nifty or BSE Mid Cap Index, you would have never lost money. So at least you would have your capital would have been protected. So that's the fund manager's call, and that's where the difference is all about, mainly on the time horizon.
I'd like to look at another aspect of the market, which unfortunately is not getting much of attention, which is the uncertainty in the bond markets. Why is there this uncertainty in the bond market? Is this related to the Yes Bank? Senthil, first you, and then I'll go to Anand on this. So the bond markets, you always expect it to be relatively more stable, and you don't expect uh, uh, too much of uncertainty. Bonds definitely don't like uncertainty, right? So do you think there's some signal coming out of the bond markets as well, Senthil? Do you think it's a signal which you should look at carefully?
See, uncertainties always is a part of a financial system. So either irrespective of equity or bond. So bond, the uncertainties, the characteristics are different, and then for equity, the characteristics are different. But obviously, equity markets always looks bond market as a indicator, and then they do take call based on the bond markets do.
So essentially, the 81 Yes Bank, in the example of the Yes Bank, the 81 bonds, which even Anand mentioned, do you think the market is reacting to something in that? Is that would you attribute that as a reason?
I will not attribute fully to that. To an extent, yes. But what is happening is like globally, the entire interest rate is coming down, moving towards zero rate. So even if you look at Bank of England, some 2 days before they have cut down the rates from 0.75 to 0.25. So everyone is moving towards zero. And when we are moving towards zero, obviously every market reacts, every financial system reacts, irrespective of bond or equity. So that's where the uncertainty comes, and everyone is questioning, or everyone has the uncertainty in the mind, like what is more in the system. So will we go to the negative rate? So that's the next question coming into the mind, because there are no more cushion with all the countries left out, because everyone is moving towards zero, right from US, Europe, Japan, and everyone. So that's where the uncertainty comes out.
That's
And yeah.
Yeah. So Anand, my question to you would be in the same lines. The uncertainty in the bond market. I think what Senthil does say is also true, right? That's why you have markets for to factor in.
No. Let us look at.
One thing. So do you think the RBI? It's time for RBI now to act. Do they need to get some sort of liquidity mechanism in place? We saw it in the case of the Federal Reserve. So do you think an emergency cut or something like that would now help?
No, not at all. See, I'll explain this to you. If you go back and look at the last Thursday when the RBI acted in haste in Yes Bank, you can see that IndusInd Bank was supposed to come up with a 2,000 crore bond issue. IDFC was supposed to come up with a bond issue. Both IDFC and IndusInd Bank, both are very strong banks and well-capitalized banks. And the promoter of IndusInd Bank has sunk in 2,000 crores after that. They have deferred the bond issue. So, and all these tier 1 bonds have gone into either the opposite side bank or into mutual funds.
Yeah.
So there is a study which says 25% of all debt market mutual funds are with perpetual bonds. The Reserve Bank was irresponsible in doing whatever it did, and definitely the markets have to pay a price. We cannot say that I will write down the bond to zero before I write down equity, which is definitely a more riskier capital, and act as if nothing is wrong in the situation in the market. Definitely, the fundraising plan of IDFC and IDFC and IndusInd is definitely affected by the irresponsible behavior of the Reserve Bank. Obviously, people don't want to say this openly because I don't have any axe to grind. But definitely, Larsen and Toubro has gone to court today. Axis Trustee has gone to court. All the mutual funds have gone to court. If everybody is hunky-dory with what the Reserve Bank has done, why will people oppose the court? So, definitely, the Reserve Bank has acted irresponsibly and sleeping on the wheel as far as Yes Bank is concerned. As far as the global interest rates are concerned, then when markets turn choppy, people take the money and fly to quality, that is treasury and gold. Gold has valued nearly 28%, 25% this year, Venki. and the treasuries have first time closed below 0.5.
Yeah.
So basically, the bonds have just surged internationally because for the simple reason people want to park money in US Treasury and gold, and the Indian fund managers. I don't want to take a name of a senior person in Bombay. Is highly irresponsible of him yesterday to tweet that the Reserve Bank should sell its foreign reserve and punt on oil futures. If the Reserve Bank is if we are going to have fund managers who advise the Reserve Bank to sell the treasury and park it in oil futures, tomorrow when the person asks for dollar, will you go sell the future and bring the money? It is not Reserve Bank's money. Tomorrow, if I have a right to take the US dollar, the Reserve Bank has to produce the US dollars automatically.
And no, I agree. I do. We should not name, but I do understand. I mean, I think probably what he meant was at these lower levels, try to tie
No,
in
no, but to
term.
suggest that for a very respected, supposedly respected and a senior fund manager to suggest even in a public social media that Reserve Bank should sell its reserves and buy oil futures is a height of irresponsibility. What kind of knowledge are we talking about?
Okay, we'll come to that. Another question. This would be for you, Senthil. The foreign institutional investors, right? They have been continued to be. We are seeing for the first time, as he says, everything from 3 months to 30 is below the 1% mark. This is unheard of when it comes to global yields, right? So how have the FII been behaving? They were net sellers from, I think, February itself, and they seem to have continued with that. Is that also a very important reason, because FIIs are not there around to actually go out and pick up some stocks which are available or stocks which have value in them still at these levels?
No, when there is an uncertainty, obviously everyone will try to pull the money from the system. So for FIIs, there are 2-3 reasons on the global front. One is obviously the COVID-19, and number two, the oil has plummeted to $30. So when the oil goes down, obviously oil is a reflection of economic activity. So they see it's across the world the economic activity will come down, and so entire economic growth will take for a while. That's why they pulled out the money. It's not only in India; it's across the world. So that's why entire world markets have fallen in the range of 15 to 20%. So if India alone has fallen, yes, then we can say there are some domestic issues with respect to India. But this is with respect to across the world. And for them, when they pull out the money, it's all dollars. So it's more about dollar depreciating. It will hurt their returns. So it's a cyclical issue. So all these three put together, they pulled out the money, and it's a normal fact. So immediately tomorrow, if some even small positivity comes, they are the first ones to come and buy. And again, immediately you will see the reversal of the entire market. Like what we have seen, like 8% down or 9% down today, it can easily reverse the 9 and 9% plus, and then it will be done. So the same thing will happen in the coming future also, when we see some kind of positive signs.
Okay, so just two last questions, and this would be for both our panelists. Are there any specific sectors that people could look at? I mean, I don't know. Do we continue to stay invested? Do we wait for opportunities to buy? So we would start with Anand, and then we'll end with you, Senthil, on this. So what do you think, Anand? What should people be doing? Because
No, I think the retail investors should stay away. This is not the time for them to invest because as Amos Tversky and Daniel Kahneman have taught us that a loss is very painful and twice as painful as a profit. So people who do not know this game should stay away. And I also believe that Nirmala Sitharaman, in her hurry to meet the budget deficits, is dumping stocks which are there in the SUPI, which he got as a part of the UTI restructuring. Her predecessor, Yashwant Sinha, got it, and she's dumping those stocks. Those stocks are about 13-14% down in the market. These are debt-free stocks. So if you can hold them for a decade, you will make a lot of money, yes. But I again say retail investors should stay completely out of this.
Senthil, your take. What did you advise, especially people, retail investors? Do we continue with our SIP? Do we stop our SIP? Do we commit more and things like that? So, I
So I
don't
will go with
want
the
a statement to make you outside, but just to get your idea.
Yeah, I will go with the past fact. So from we have done some analysis since 1990. Whenever Nifty has fallen 20% in a month, then the next 6 months, the period has been given a return of say plus 25 to plus 60%. That's what has happened since 1990. So going by the history, going by the fact, given all the turbulence the retail investors have already faced, who are already invested in the market, so they should keep invested, and then sometimes they can. I mean, SIP is a good process because obviously they can average it out. So the next nearing the next 6 months, maybe I mean it will be very positive, and they can reap all the returns going forward. That's going by the history on the fact side. One, and number two, on the sector specific questions. Still, there are certain sectors which are totally unaffected because of this, and because of oil coming down, there are certain sectors and there are certain companies which will benefit in a huge way. And even for the economy, for every $10 drop in the oil, there will be a huge saving for the fiscal side for the economy, or if they pass it on to the consumer, there will be a huge savings for the consumer, and in turn, again, it will increase the disposable income. So the investor should look at these kind of sectors and domestic foreign relation sectors where there can be a shift from business of from China to India for a diversification purpose for the world people and world markets. So those are all the sectors we will be interested in, and which are likely to give returns in the coming future.
Okay. Thank you very much, Anand and Senthil. We hope to be doing more of this. Thank you very much for having taken time on such a important and a busy day and joining us on this live webcast. Thank you once again. Namaste.
Namaste.
Thank you, Venkat.